Hi, and welcome to the Day Trading for Beginners podcast. This is episode 28, and in this episode, we're going to talk about chart patterns and reversals. So it's going to be very much an introduction to chart patterns, and we're going to focus on one in particular, the head and shoulders pattern. So there are many more. We can't really talk about all of them on a podcast, and you'll certainly want to have a visual of these as well. But I thought we would just have a bit of a deeper discussion about the head and shoulders one, because that is one of the most popular ones. It's one that has a good sort of reliability score in terms of, when you see the chart pattern, is there actually going to be, a reversal to the downside or upside? And then again, I would encourage you to just check out other resources to see some visuals and to learn about all the other patterns. So for me, studying this section, I have been using the textbook, the technical analysis of the financial markets. I'll have a link to that resource in the show notes below. Chapters 5 and 6 sort of talk about this discussion, or this topic, on chart patterns and reversals. And then there's other sort of YouTube videos and things out there, but I would recommend that textbook. I've been using it quite a bit in this technical analysis sort of section of this journey. I've actually bought the audiobook, and that's actually a really good listen if you're driving. And then I have bought the study guide as well. It's something I plan to do over the next few months, really dive deeper into that book. Our discussion so far about technical analysis in this podcast, it's been very much in sort of an introductory type of level. We've touched on everything sort of at like an introduction sort of level, but certainly, over time, you'll want to learn these things in more detail, and you'll want to learn, more detail about a lot of these things. Certainly, we're going to talk today, but you can. There's a lot we just don't cover on the podcast that the textbook goes into more detail. So I would certainly recommend that for you as well. So again, we are on a journey to become a full-time day trader. We are studying technical analysis. And if we kind of look back on what we've talked about in the previous episodes, we talked about volume last week. We talked about technical indicators, support and resistance, charts, and trends in general. We talked a little bit about the anatomy of a candlestick on the YouTube channel, and then sort of just what technical analysis actually is. So now when we're kind of looking at chart patterns, we kind of, incorporate a lot of what we spoke about before into these chart patterns, into eventually the candlestick patterns, and then obviously, incorporating everything into your strategy, which we hopefully will talk about sort of later in the year. But, we are sort of progressing nicely, and things certainly do build on each other. So for our discussion here about chart patterns, we'll be able to see that, trends and trend lines are important when looking at chart patterns. Incorporating volume is going to be important in terms of, how confident a trader might be that a pattern is sort of developing. And then obviously just understanding, candlesticks and what those are in terms of a chart pattern is important. And then understanding, where levels of support and resistance might be, those can factor into, the development of patterns as well. So in terms of, to make successful trades, you could argue that you need conviction in, your strategy or your knowledge. Or what you see. So conviction followed by market confirmation. So, you're convinced that you're seeing a pattern, and then the market does confirm it. Well, what if, I told you that, this conviction often comes from recognizing patterns in market price action. So imagine having the tools to spot these patterns and then make informed, profitable trades. Well, that's sort of what this podcast is about. On an introduction sort of level, we're going to, get introduced to these patterns and these reversals, and highlighting, some of the more common ones. But that's sort of what the ideal is with these chart patterns: being able to spot them, predict them, have conviction, confirmation, and then make your trades and become profitable. So just some important things to cover for this before we start. And I got this from the textbook, the author John Murphy, the textbook Technical Analysis of the Financial Markets. Understanding chart patterns and reversals it is a fundamental aspect of, technical analysis and trading. That's what we're doing as, day traders. And again, these patterns, they help us predict potential price movements. But there are some things to keep in mind. And the author does mention this in chapter 5, basically saying, firstly, while these chart patterns work, often or most of the time, especially the head and shoulders one, it's got like a 70 or 80%, win rate or success rate when it forms. They don't work all the time. So it's important to understand that, no pattern is foolproof, and market conditions can cause patterns to fail. So this uncertainty, it's inherent in trading, and it's just vital to accept it as part of the process. So no pattern is foolproof. And then the second thing that is mentioned is the ability to identify when a pattern is wrong is just as important as recognizing when it is right. So knowing when to cut your losses is a critical skill for any trader. And I remember just over the last, how long it's been here, 5 months or so, I always see this point about limiting your losses. It's so important. So preserving your capital, limiting losses is key to surviving as a day trader. So, you might recognize a pattern, but if, it is wrong, you need to understand that, get over it. You made a mistake and cut your losses. So it's important to understand when patterns are right and notice them. But if something's wrong, you need to be able to notice that as well. So I thought, certainly that was an important thing that was mentioned. And again, it just goes to that whole notion that, cutting your losses is really important as a day trader. Okay, so understanding these chart patterns, again, what they actually are, they are formations that are created by the price movements of a security. So we're talking normally stocks, but these price patterns are happening in the Forex market. So when currencies are getting traded and so on in other markets as well. So these patterns reflect the psychology or the psychological behavior of the market participants, and they can predict future price movement. So recognizing these patterns that can help us make informed decisions and then increase our chances of making a successful trade. So before we dive into the patterns, I thought it was just important to just quickly cover and review what these trends actually are. So remember, an uptrend, that is defined by higher highs and higher lows, indicating that the market is moving up and to the right. So, the price always goes up and down. There's always peaks and there's always troughs. So if the price moves up to a peak and comes back a little bit and it hits a trough and then reverses back up, well, the next peak has to be higher than that previous one. And then the low has to be higher than the previous low. And that is an uptrend. And then for trend lines, you would draw it up on the lows, up and to the right, connecting the low. So an uptrend is higher highs and higher lows. Downtrend, obviously, it's the reverse of that, lower highs and lower lows and sloping down and to the right. And then we've got sideways trends, also known as horizontal trends. And these occur when you've got the highs and lows that sort of remain relatively consistent, indicating that the market is moving sort of within a range. And then you draw trend lines, over these, and these become your resistance and your support levels for certain areas on a price chart. So again, important to know those when you're actually looking at various chart patterns. So again, the most common one for a reversal pattern is the head and shoulders. So reversal patterns, what these do is they indicate that a change is happening with the trend. So they signal that the existing trend, it's losing momentum and a new trend is likely to begin. So recognizing these patterns can help traders spot potential turning points in the market. So if you're able to spot a trend that's happening, if you think about it, if you're in an uptrend and you're rising and you can spot a pattern that is going to dictate that it's going to reverse into a downtrend, and there's, a high probability that that might happen, you can see where you can get an edge in the market and potentially make profitable trades. So again, the most popular one is this head and shoulders reversal pattern. So I thought we would discuss it here in the show notes. I'll have a link where you can actually see an image of these. And you can always just Google, head and shoulders reversal pattern images, and you can kind of see some real examples of these. So that's going to be something worth doing as well. So the head and shoulders pattern, it's reliable and it's widely recognized in the technical analysis sort of world. And when we say reliable, basically, don't quote me on the percentage, but it's something like 70 or 80%, meaning that after it forms, there's a high chance that the trend is going to either go in a certain direction. So, once these head and shoulder patterns form, maybe like 70 or even higher percent of the time, the trend does move in a specific direction. So that's really, really good. And that sort of goes to this whole notion that, price moves in trends and history repeats itself. That's sort of like the philosophy of, technical analysis. And then, these trends are just proof that this stuff works. So what you have with this is you have a left shoulder and you have a head and you have a right shoulder. So it's the head and shoulder reversal pattern. And that's basically what this looks like on a chart. So, the first peak that forms after a strong uptrend, it's followed by a decline. That is the left shoulder. So you've got a peak and then a pullback. That's the left shoulder. And then you have the head. So that's the second peak and it's higher than the first one. It represents like the highest point in this pattern. That's the head. And then it's followed by another decline, usually to the level near the bottom of the first trough there. And then as it goes back up, you have another peak that forms, and that's going to be the right shoulder. And it's going to be lower than the head, but similar heights to the left shoulder. And then you have another decline. So that's what it is. You've got a left shoulder, you've got a head, you've got a right shoulder, and then the peaks and troughs sort of form this pattern. Now you do have what's called a neckline, and that is an important line. It's drawn by connecting the lowest points of those two troughs between the shoulders and the head. And this line can be horizontal or it could be slightly sloping up. It can be sloping down as well. And, whether it has that slope sort of dictates the, strength of the head and shoulders pattern. But this line is important as we will learn when the price comes back and breaks through that line. That is sort of an indication that, hey, the pattern has been sort of complete. So the head and shoulders pattern, it's significant because it marks a weakening of the uptrend and a potential reversal. So when price breaks below the neckline on the final stages, it confirms that the pattern, this pattern exists. And then we have what's called a bearish reversal. So we're coming down. So we've been on an uptrend. We have a shoulder, a pullback, a rise up to the head, another pullback, a rise up to the second shoulder. And then as we come down and we cross where there's that imaginary sort of horizontal neckline between the two troughs of each shoulder there, we break that line. And this indicates that the buying pressure that sustained the uptrend is diminishing and the selling pressure is taking over. So again, diving into it a little bit more here, that formation of that left shoulder, the price rises to a peak and then declines. So that creates the peak. This peak, it's typically occurs after an extended uptrend. And then talking volume here, volume tends to be high on that left shoulder as it forms. So the volume, the trading, the amount of trading is relatively high with that left shoulder. Then in terms of forming the head, the price, rises again off the trough, forming a higher peak, higher than the left shoulder. And then this peak is the highest point on the pattern. And then in terms of volume may decrease slightly during the formation of the head of as opposed to the left shoulder. So you might have more volume in the left shoulder and then less volume in the formation of the head. And that can be just another confirmation that we're sort of losing steam in this uptrend. And then forming the right shoulder, again, the price declines from the head, but then rises back up to form that right shoulder, which is lower than the head. And that right shoulder, it should be roughly equal to the height of the left shoulder. And then volume during the formation of the right shoulder is usually lower than during the formation of the head and the left shoulder. So again, throughout this pattern, volume usually is the creasing. And then you've got the neckline and the breakout. So we talked about that. You can draw the neckline connecting the lows of the two troughs between the head and shoulders. And then the pattern is confirmed when the price finally breaks below that neckline with increased volume. So you'll generally see more traders coming in. There's more selling pressure. There's lots of trades, and the trend line is going down, and it breaks that neckline with lots of trading volume. And that can indicate that, this pattern has formed. So example, imagine the stock, it's been in an uptrend. The price is rising to the left shoulder. Then it declines. It rises back up again to the head, higher than the left shoulder. It declines again and then rises once more to form the right shoulder, which is lower than the head, similar height to the left shoulder. The price then declines and breaks below the neckline, confirming the pattern and signaling that the trend reversal is formed. We've moved from bullish to bearish. So that's sort of like a summary of it there. Now, in terms of volume, we mentioned volume there throughout that quick discussion. Volume plays a crucial role in this chart pattern. Again, typically, you always say usually because it's not always needed. It can confirm, but the volume doesn't always have to be this way. But typically, or usually, volume is highest during the formation of the left shoulder and then decreases as the head forms. And then volume may increase slightly during the formation of the right shoulder, but it doesn't always. It can actually just gradually go down, but it's usually lower than the left shoulder. And then the confirmation pattern comes when there's a lot of volume, as we mentioned there, as the price breaks below the neckline. Now you can actually measure this. So again, talking through this, you can see how technical you can get with these patterns, measuring the moves. So to estimate the actual price move after that neckline is broken, you would measure the distance from the head and the neckline. So that distance from the neckline to the top of the head can be thought as the distance that this move is going to break down after breaking the neckline. And then, you do have an inverse head and shoulders. And again, we won't talk about that in detail, but that would just be everything that we've talked about, but just the opposite way. And as it's forming down into, a downtrend is forming, and then you've got a head and shoulders, and then you've got a breakout up and to the right and turning into a bullish reversal. So it's almost like a flipped image, a mirror image of what we have just spoken about, but in a down trend. So that's the head and shoulders pattern. Certainly one to study, one that you want to maybe see some images of, see some real actual examples. You can always, in Google search, head and shoulders price pattern plus trading view, and then you can see some actual images on the trading view software if you want. And I actually went and asked Grok to give us sort of a fun explanation of the head and shoulders pattern. So to summarize and just to sort of sum up this discussion on head and shoulders, why don't I read what Grok sort of gave us. And it's just sort of a fun way to think about this and maybe just to get you to relate to certain things to help us really understand what this head and shoulders pattern is. So I asked Grok, give us a fun explanation of this. And here's what they shared. So the head and shoulders pattern is like a soap opera drama unfolding on your stock chart. Picture this. The market is in a long-term relationship with an uptrend, but then out of nowhere, a mysterious character called the head appears. This head is a higher high that makes everyone gasp in disbelief. But wait, there's more. The head is flanked by two shoulders, which are lower highs. The left shoulder is like the market's first attempt to break up with the uptrend, but it just can't commit. The right shoulder is the market's final attempt to rekindle the old flame, but alas, it's too little, too late. Now imagine a neckline that connects the two shoulders. This neckline is like the breakup line drawn in the sand. When the market finally crosses below this line, it's like the market saying, I'm done with this uptrend. The head and shoulders pattern is a classic sign of a trend reversal. It's like the market saying, I've had enough of this drama and it's time for a change. And just like that, the market breaks up with the uptrend and starts a new relationship with a downtrend. So my dear human, the next time you see a head and shoulders pattern on your chart, just remember, it's not just a pattern. It's a soap opera of market emotions. So I thought that was kind of fun, kind of explained what we talked about in technical details in sort of a fun and relatable sort of example. So I thought that was good. So that's the head and shoulders pattern. So that's the most popular reversal pattern. And again, I would recommend that you get familiar with it. I'm personally going to study it more, look at some more real examples, have some visuals as I'm going through that sort of technical explanation of what that pattern is. Now, there are other ones. So there are double tops and double bottoms. I'm not going to get into too much detail here, but you can just, picture an M formation. So the price is in an uptrend. It makes two consecutive highs at roughly the same level, forming like an M shape. And then the neckline formed at the recent low acts as a support level. And when you break below that neckline coming down, that confirms that there is a bearish reversal. And then you have the same thing flipped as a W shape, which is a double bottom, taking on the same characteristics. And then you also have triple tops and triple bottoms. So, price of an uptrend makes three consecutive highs at roughly the same level. And then the neckline can be formed, creating a support level there. And then as you come down, you break that neckline. That indicates that, that uptrend is now turned into a downtrend. So again, triple tops, triple bottoms, double tops, double bottoms. Certainly these are also quite reliable, not as reliable as the head and shoulders pattern, but that's another significant pattern that you will want to get familiar with. Then there's other ones such as the rounding bottoms and tops, there's V bottoms and so on. So, other ones that you will certainly want to learn more about. Now, there are some key elements that are shared with all of these reversal patterns that I thought it would be important to share here on the podcast. So the first one here, the key elements that these reversal patterns have, firstly, is this idea of an existing trend. So obviously, for a reversal pattern to be valid and exist, there must be an established trend to actually reverse from. So these patterns, indicate a transition from, say, an uptrend to a downtrend or vice versa. So there has to be a trend that the stock or that the security is in for there to actually even be a reversal. Then this idea of breaking a trend line. So the reversal pattern is confirmed when the price breaks the trend line of an existing trend, signaling a new trend. So, certainly when you're studying trends and you study them a bit more, sometimes, the candlestick or the charts can break down off an uptrend, but they can certainly go back into that uptrend. It might just mean that the uptrend is maybe not as steep as before. So it's important to understand that, sometimes trend lines can appear to be broken, but they are just adjusting, and then you continue on into the uptrend. So certainly not all trends get reversed when there is, a slight breakage in the trend line. The other thing that's important, pattern size and movement. So larger reversal patterns often lead to greater subsequent price movement. So the size of the pattern correlates with the magnitude of the expected move. So, you might, these head and shoulder patterns aren't going to occur in a very short amount of time. If they take longer to build, then what that is suggesting is that when it does actually reverse, it can be more, the magnitude of the reversal can be expected to be much higher. In terms of the development of the pattern, sometimes these reversal patterns, again, they take quite a bit of time to develop. They often form over perhaps a few weeks or months, providing traders with, enough warning that a trend change may be imminent. Topping patterns, typically shorter in duration and can be more volatile when compared to bottom patterns. And then we talked about volume. Again, volume plays a crucial role in sort of confirming reversal patterns and that they're happening. Again, typically volume increases at the start of a new trend. So for example, during a bullish reversal, volume should expand to the upside. And we talked about that when it breaks the neckline and we have a reversal happening, generally volume is going to be higher. In terms of, breakout and then confirmation, the pattern is complete when the price breaks out of the pattern's boundaries, signaling a start of a new trend. So that trend, that neckline in that example we talked about, would be the start of the breakout. So sort of understanding, these characteristics, it's going to help you better identify when a reversal pattern might be happening. So those are reversal patterns. Now there are also what are called continuation patterns. So for these, a continuation pattern, basically it's going to suggest that the existing trend will continue after a brief period of consolidation. So prices might be going up and then they might consolidate and move sideways for a little bit until they, continue on. So they might just take a little bit of a breather, take a rest, and then over time move back up into the trend that they were in. So recognizing, these patterns, again, is going to help you be able to capitalize on the ongoing trend. So, trading with the trend is always good. And if you can see that a continuation pattern is happening, it could give you confidence to, trade into that trend that's going to continue to happen. So we're not going to talk about the specifics, but there are continuation patterns that form just like the head and shoulders pattern will form. And you can recognize these on charts. So there's triangles, there's things called flags and pennants, channels, wedges that form and so on. So we're not going to talk into the specifics of those, but I would recommend that you get familiar with those continuation patterns as well. So sort of in summary, they're talking about those two things. Reversal patterns indicate a change in the prevailing trend, and then continuation patterns are going to suggest that the current trend will resume after a brief period of consolidation. And, some stocks and some investments, securities consolidate for a long time. So the timelines for these can be, sometimes can be short, but sometimes certainly can be long. But just understanding the differences between these two types of patterns is going to be important for you. So continuation patterns, triangles, flags, wedges, things like that, they're going to help you identify opportunities to potentially rejoin the trend. And we sort of mentioned that there. Again, traders, when you as a beginner, this stuff is all new, but when you are well versed and you can sort of recognize both continuation and reversal patterns, it's going to be just so much more effective for your trading. And again, mastering both, it can just improve your overall strategy. So when you have a strategy in place, eventually, we're going to learn a strategy and adapt one, but having the knowledge of all these patterns, being able to see them, is obviously just going to make your trading much more effective. Now, in terms of, looking at the charts and being able to see these patterns, you're going to obviously get visual cues. Looking at past data is going to help you learn to be able to recognize these. There's going to be volume confirmation. So we talked about that as well. And then you'll probably eventually, when you start doing this, use multiple time frames. And doing that's going to be able to validate patterns using different time frames for more of a sort of comprehensive analysis of what you are looking at. And then we talked a little bit about strategy. We don't want to talk too much about it, but obviously neckline break entry, that's an important strategy. So when it breaks that neckline, that would be a time to, potentially enter a trade. Pullback entry. So you might want to wait for the price to pull back to the neckline for that support and resistance area, and then making a trade. Key level entry. So combining, patterns that you see with other things other tools that you have in your toolkit. So, seeing patterns and then being able to recognize any support and resistance levels. There might be indicators that you would combine with this. You might actually eventually study the candlestick formation. So we haven't talked about candlestick patterns, but obviously, what the price action is doing in a specific time frame is going to be also important to use as you are seeing potentially some of these chart patterns form. So again, eventually, once you get a handle on everything that has to do with your toolkit, with your technical analysis, you can kind of see how all of these things sort of work together. So in terms of sort of summing up this podcast here, what we kind of did is we just talked about the basics of chart patterns, that they exist, that they're important to understand, that they are not always there. Nothing's foolproof. It's important to recognize when, something might be going wrong, but it's also important to understand that history repeats itself. These patterns do exist, and some of them have, a high, quote unquote success rate. So understanding these, it's going to be important for you as a day trader. So again, chart patterns should not be traded blindly, but as we sort of talked about there, forming these and understanding these, using price action along with seeing these chart patterns form, using other indicators, all of this stuff coming together is going to be helpful for you as you are developing your strategy and you eventually start making some trades. So I think we'll stop it there. I hope that you found that useful. Again, patterns are something that you will want to go out and learn more about. Personally, I'm going to try and get familiar with all of the major ones. We mentioned them here. Obviously, we don't have enough time to go into all of them in detail on a podcast, but that is something that I'm certainly going to do moving forward as I continue to study this technical analysis section. And again, as we progress through this journey of becoming a full-time day trader. So thanks so much for listening. I hope that you found this useful. You can subscribe to the podcast. Again, if you've not downloaded my 6-month blueprint, at the time of recording this, we are getting close to the end of that 6-month timeline. So we're going to have a few more technical analysis episodes. We might have an episode about trading journals. And then what I'm going to do is I'm going to do a full update on the blueprint. So if you've not requested to download that yet, certainly go ahead. I will be sending out emails when that gets updated with everything that we've covered over the last 6 months. So that's certainly going to be something handy for you to have on. In terms of timeline, it doesn't mean that you need to do it in 6 months. It might take you longer, or you might be able to get it done in 6 weeks, but it's a good sort of step-by-step structure on what you probably should be doing in the beginning stages of your journey to become a full-time day trader. So again, you can go to stokestrades.com/blueprint if you'd like to get access to a copy that will be updated as well. So thanks so much for listening. And I will talk to you in the next podcast.